Welcome to the first episode of the Working Thesis. I'm Nova.
And I'm Onyx. This episode is the context layer, the part we do once so every future market update doesn't have to spend 5 minutes explaining the worldview.
The basic idea is simple. We don't try to predict markets. We maintain a set of macro theses, then use market data, news, earnings, money flows, and AI-assisted research to ask whether those theses are becoming more or less true.
In other words, this is not a channel about being right loudly. It's a channel about being less wrong with receipts.
Quick disclaimer. This is personal market commentary, not investment advice, not a recommendation, and not a forecast. Everyone has their own judgment. Our job here is to explain the framework and show how we test it. Most market commentary starts with prices. Index is up, yields down, stock X beats earnings, commodity Y breaks out.
That's useful but incomplete. A price move only matters if you know what question you're asking.
The worldview behind this show starts with a few slow-moving beliefs. First, demographic growth is slowing or reversing in much of the developed world, and in China. That means organic growth gets harder.
Second, sovereign debt has become so large that traditional repayment through austerity or high real growth looks politically and mathematically difficult. The softer path is usually currency debasement, financial repression, or inflation quietly doing the work.
Third, the world is fragmenting geopolitically, but full decoupling is still economically hard. The US has capital, software, semiconductors, and research. China has manufacturing scale, supply chains, and industrial execution. The relationship can get uglier, but total separation would be very expensive.
Fourth, every digital story eventually hits a physical constraint. AI may look like software, but it runs on data centers, electricity, transformers, copper, cooling systems, power contracts, and grids.
And fifth, from an enterprise software lens, incumbents often adapt better than people expect. Distribution, compliance, installed base, and customer trust matter. A better model alone does not automatically replace a platform embedded in 1,000 business processes.
So the worldview is not bullish or bearish. It's a map of constraints: demographics, debt, energy, technology, and geopolitics. The market is just the daily weather moving across that map.
Thesis 1 says AI build-out continues because productivity growth is not optional. If demographics are slow and debt is high, societies need a productivity engine. AI is currently the most visible candidate.
The last year gave real evidence. Hyperscaler capital expenditure estimates for 2025 moved into the hundreds of billions. Some 2026 estimates for Microsoft, Amazon, Alphabet, Meta, and Oracle combined are in the $600 to $700 billion range, with a large share aimed at AI infrastructure: GPUs, servers, data centers, networking, and power.
That's not small experimental spending. That's infrastructure-scale spending. It doesn't prove every dollar earns a great return, but it does show the companies with the deepest pockets are treating AI capacity as strategic.
This thesis gets tested through CapEx guidance, NVIDIA data center revenue, fab equipment cycles, networking bottlenecks, and whether enterprises actually put AI into production workflows.
What would weaken it? Hyperscalers cutting CapEx guidance for multiple quarters, NVIDIA data center growth slowing materially, or fab CapEx turning negative. One weak stock day doesn't break the thesis. A coordinated CapEx retreat would.
Said another way, the stock chart can sneeze. The thesis breaks only if the build-out catches pneumonia.
Thesis 2 is related, but different. Incumbent enterprise software companies may absorb AI value rather than get destroyed by AI-native challengers.
This comes from an engineering lens. Enterprise software is not just features. It is permissions, compliance, audit trails, integrations, data residency, procurement, customer trust, and years of workflow history.
The evidence from the past year is mixed but important. Enterprise AI adoption has broadened quickly. Surveys vary, but many large enterprises now have at least one AI initiative in production. At the same time, only a much smaller share described their AI rollout as mature or deeply transformational.
That gap matters. If AI adoption is broad but still operationally messy, incumbents have an advantage. They already live inside the customer's workflow. Microsoft can put AI into Office, Azure, GitHub, and security. Salesforce can put AI into CRM workflows. ServiceNow can put AI into IT and business automation.
But this thesis is fragile. If customers start leaving incumbents for AI-native alternatives, or if AI compresses seat-based pricing faster than incumbents can adapt, the thesis weakens.
So daily data matters here. If software beats earnings but sells off repeatedly, that may indicate investors are questioning whether AI is additive or cannibalizing. That's not a conclusion, but it is a signal.
The framework does not say incumbents always win. It says installed base and distribution deserve respect until evidence says otherwise. Thesis 3 is the hard asset thesis. Sovereign debt levels, especially in the United States, look structurally difficult. Recent fiscal data puts U.S. federal debt in the high 30 trillion range, deficits near $2 trillion per year, and interest expense around the $1 trillion level.
That does not mean imminent collapse. It means the path of least political resistance may be gradual currency debasement. Keep nominal rates manageable, tolerate inflation above target at times, and let real value erode slowly.
Gold fits this thesis as a reserve asset and purchasing power hedge. Central bank buying is the key support point. World Gold Council data and related estimates show central banks buying very large amounts of gold in 2025, with Q1 2026 purchases around 244 tons.
The important nuance: gold is not simply war equals up. Many crises first strengthen the dollar. If the dollar spikes, weaker currencies come under pressure, and some central banks or investors may sell reserves, including gold, to defend currencies or cover losses elsewhere.
So the gold mechanism is case by case. Inflation fear, currency debasement, real yields, central bank reserve diversification, and dollar stress mechanics all matter. The framework is not a slogan. It's a set of drivers to track.
What would weaken the thesis? Sustained fiscal discipline, central bank gold buying falling sharply for multiple quarters, or real yields staying high without financial stress. None of those are impossible. That's why we monitor.
Thesis 4 says AI is not only a software story. It is an energy and grid story.
The IEA estimates global data center electricity consumption could more than double by 2030, reaching around 945 terawatt-hours a year, roughly comparable to Japan's current electricity use. That is not a footnote.
Then comes the grid bottleneck. Lawrence Berkeley National Laboratory's interconnection queue work shows more than 2,000 gigawatts of generation and storage projects waiting to connect to the U.S. grid around the end of 2025. The queue is huge and wait times are long.
So if AI demand grows, the constraint is not only GPUs. It's power availability, interconnection, transformers, cooling, copper, nuclear, gas, transmission, and permitting.
Copper also sits in this thesis. Electrification, data centers, transformers, and grid upgrades all pull on copper. Some industry estimates suggest AI data centers can be far more copper-intensive per megawatt than traditional data centers. Supply growth is slow because mines take years.
What would weaken thesis 4? A genuine compute efficiency breakthrough that dramatically lowers power demand, canceled hyperscaler power deals, or evidence that grid upgrades and power supply can scale much faster than expected.
Until then, the AI story has a physical shadow. The cloud still needs a plug. Thesis 5 is pragmatic multipolarity. The world is fragmenting, but not cleanly decoupling.
Trade data and supply chain research over the past year point to a great reallocation. The U.S. imports less directly from China, more from Mexico, Vietnam, and other partners. But reallocation is not the same as total separation.
Supply chains move in layers. Some assembly shifts. Some routing changes. Some rules of origin enforcement tightens. But specialized manufacturing capacity, rare earths, electronics know-how, and industrial scale cannot be rebuilt overnight.
This thesis does not require saying China wins or the U.S. loses. It says the world becomes messier and more multipolar. Capital, IP, manufacturing, energy, and commodities get rearranged through a more pragmatic network.
It is also the thesis we treat most carefully. It is politically sensitive, slow-moving, and not the main content focus. The framework watches it, but does not force every week to be about it.
What would weaken it? True broad decoupling, deep structural deterioration in Chinese corporate fundamentals, or policies that make investable exposure impossible. Again, not impossible. Just something to monitor, not assume.
There is also a watchlist idea: physical AI. Robotics, humanoids, autonomous systems, and factory automation.
The logic is that software AI improves digital work, but broad demographic productivity may require machines that act in the physical world. Warehouses, factories, logistics, eldercare, agriculture. Those are the domains where labor shortages become real constraints.
But this thesis is not mature yet. The revenue base is small, timelines are uncertain, and many investable vehicles either already price in heroic assumptions or remain private.
So for now, physical AI is not a central thesis. It is a watch list. We track milestones, commercial robot deployments, revenue contribution, generalization across tasks, and whether efficiency gains start showing up outside software.
Now the key part: how this channel uses daily market data.
We are not trying to make every daily move profound. Some days are just noise wearing a tie.
But each day can still be tagged. A CPI print can support or pressure the sovereign debt thesis. A hyperscaler capex guide can support or pressure AI build-out. A software earnings reaction can test the incumbent adapt thesis. A uranium spot move, copper inventory change, or data center power deal can test the energy constraint thesis.
The goal is not to force every headline into the framework. The goal is to notice when evidence accumulates. One headline is a data point. A pattern over weeks becomes a signal. A signal against pre-committed kill criteria forces an update.
That is why we call this the working thesis. The theses are not permanent beliefs. They are working hypotheses. We keep them only as long as the evidence keeps cooperating.
And if the evidence disagrees, the thesis changes. That's the whole point. The framework is allowed to evolve in public.
Future episodes will not repeat this full framework every day. Instead, daily or weekly updates will assume this foundation.
A daily audio might say, "Today strengthens thesis 3 because gold rose while the dollar softened." Or, "Today pressures thesis 2 because software lagged despite a strong AI tape." Or, "Today is neutral for thesis 5 because the China data did not really change the supply chain story."
There will also be deeper episodes: earnings dissections, thesis dashboards, bear case specials, and occasional explainers on patterns or market mechanics.
The spirit is simple. Selective news, organized around a worldview, checked against evidence, with enough humility to update when reality disagrees.
That's episode 1. Welcome to the Working Thesis.